Welcome to the Friday Spotlight Energy Report for October 29th, 2010. Hosted by Jed Knudsen, Julia Batchison, and Chantel Flanders. Here is Julia Batchison with this week's major headlines.
Thanks, Jed. On Tuesday, Iran State Media Agency reported that Russian-provided fuel is now being loaded into the Bushehr nuclear energy plant. Iranian officials reported that the reactor may begin producing electricity by 2011. Iran will use the electricity generated to augment the country's power supply. The fuel reactor will receive 163 fuel rods during the next 2 months, enabling 1,000 megawatts of electricity production. Chevron recently approved a plan for deepwater natural gas and oil field development in the Gulf of Mexico. The cost of $7.5 billion makes this the largest investment since the deepwater drilling moratorium was lifted by the Obama administration. The two fields, called St. Malo and Jack, are believed to hold what equates to over 500 million barrels of oil. During the initial development phase of the project, Chevron will pay approximately $3.8 billion. Jason Gamble, a Macquarie Securities USA Incorporated analyst based in London, stated, "The economies of this project are robust enough to overcome any incremental cost of new regulations. That's what Chevron is telling us." Indian Prime Minister Manmohan Singh reported that his country is preparing to finalize a civilian nuclear deal with Japan and boost trade relations. Mr. Singh stated that India would like to develop a nuclear energy partnership with Japan, a country he feels has one of the highest and most advanced nuclear technologies. Under the agreement, Japan will export technology regarding nuclear power generation to India. The British wind industry will benefit from a $629 million investment from Gamesa Corporación Tecnológica S.A., Siemens AG, Mitsubishi Heavy Industries Ltd., and General Electric Company. The UK hopes to become a world leader in offshore wind energy, and these investments may help it get there. The money will help to develop the supply chain and may lower the extremely high costs of offshore wind development. Jeff Immelt, GE Chairman and Chief Executive, stated, "The UK has ample offshore wind resources that can provide clean energy for the UK, as well as providing new high-skilled jobs for both GE and our suppliers in the UK." He expressed that the company, which has investment plans of €100 million, is prepared to jump in with both feet, stating that GE is ready to invest in the UK and hire the engineers, technologists, and other skilled workers needed to make this a reality. While the wind sector is seeing expansion in some areas, not all news is good news for wind supporters. Vestas Wind Systems announced that it will lay off 3,000 employees because it generated less European business than expected. In addition, First Wind Holdings is facing price pressure regarding its U.S. initial public offering. Vestas announced that its growth within Europe has not been as the company projected in early 2010. Orders in 2011 are expected to be 7,000 to 8,000 megawatts. This is a decrease from the expected 2010 figure of 8,000 to 9,000 megawatts. The company reports that it is facing a market characterized by great uncertainty and fierce competition. First Wind had hoped to have an initial IPO offering that would raise close to $300 million, $78 million of which would be used to pay down debt. The initial offering of about $25 per share has been met with considerable resistance. However, the company is now expected to offer pricing in the $14 to $20 per share range. Now over to Jed for our top energy news stories in the United States.
Thanks, Julia. Envision Solar and General Motors are partnering to provide GM dealers selling the plug-in electric Chevy Volt with charging trees that run on solar power. This will help offset the impact that these and other electric cars make on the electric grid. Envision solar trees maximize energy generation by tracking with the sun. They are installed in configurations of 1 and 6 parking spaces, with each space generating the electricity required to fully charge one Chevy Volt within a day. These trees are already present on university campuses in the U.S. Starting in late 2010, they will be installed at the GM World headquarters in Detroit, Michigan, as well as GM dealerships located in key markets for the Chevy Volt. These include Connecticut, New York, Washington, D.C., Michigan, Texas, and California. Washington is starting to shift its focus to promote the biofuel industry. Rather than traditional tax incentives, the Obama administration is focusing on financial infrastructure to increase renewable fuel distribution. Agricultural Secretary Tom Vilsack confirmed upcoming changes to the subsidy system. Mr. Vilsack stated, "We need to begin to think about reforms to the ethanol credit program to make it more efficient and effective at addressing the full range of challenges we face in meeting our goals for traditional and next-generation biofuels." On Wednesday, ground was broken on the first solar energy plant located on federal land. The Ivanpah project is located in the Mojave Desert in California at a site within 5 miles of the Nevada border. California Governor Arnold Schwarzenegger and U.S. Interior Secretary Ken Salazar were among the officials in attendance at the groundbreaking ceremony. Now over to Chantel with more energy news from around the world.
Thanks, Jed. To assist Japan with emission offsets, $4 billion was set aside by the Japan Bank for International Corporation. The money will be invested in carbon and renewable energy projects through March 2013. The country wants to achieve a 25% reduction in greenhouse gas emissions from 1990 levels by the year 2020. JBIC Executive Director Fumio Hoshi stated, "We will fund projects on both a bilateral level and multilateral basis through loans and investments in environment funds." As early as the end of this year, 2 distinct classes will emerge in the UN emissions market. By November, the European Commission hopes to publish an offset restriction impact assessment. The Commission wants to limit credits from improperly regulated projects, as well as those that provide developers with excessive profits. In the future, the Commission may propose banning credits from projects that reduce gas and hydrofluorocarbons. Such a ban would increase EU carbon market compliance costs by 18%, estimates New Energy Finance. Through about the year 2015, UN credits accepted are estimated to track EU allowances. This is because the ban will reduce the supply of CERs. SHANA, the Iranian oil ministry website, reported on Monday that Iran will enter a $5 billion contract for development of its Farzad B offshore gas field with a foreign company. The in-place gas reserves of this field are estimated at 21.7 trillion cubic feet. Of this, 12.5 trillion cubic feet are recoverable. State-run ONGC is the leader of a consortium with exclusive rights for exploration of the Farsi offshore block. Whether ONGC is the actual foreign company taking part in this latest deal remains to be seen. That is your energy news for this week. For more headlines, visit us at worldenergymedia.com. This is Chantel Flanders for Jed Knudsen and Julia Batchison at World Energy Media. Thanks for watching and have a great day.